Rajiv, so can you take us through the life of your uncle to begin with? Your uncle, of course, was a great inspiration for the late Parag Parikh.
My uncle, Mr. Chandrakant Sampath, was a very simple man. He pioneered the idea of compounding into the Indian equity market. In his later part of his life, very worried about protecting his wealth rather than making, many times more than what he already had.
What percentage of the portfolio do you generally churn in a single year?
Not more than 15%. The power of compounding gets disturbed with churn, and that's what we want to absolutely avoid.
Hello, this is Neil Borate. I'm deputy editor at Mint. And with me today is a very special guest. Rajiv Sampath currently manages the Sampath family office, but he was earlier director at Parag Parikh Financial Services. And of course, Parag Parikh himself was a big disciple of Rajiv's uncle, the late Chandrakant Sampath, who was one of India's greatest value investors. Today we talk about Chandrakant, his legacy that Rajiv inherits, and how Rajiv himself manages the family office. Rajiv, welcome.
Hi, Neil. Thanks for having me on the show.
Rajiv, so can you take us through the life of your uncle to begin with?
My uncle, Mr. Chandrakant Sampath, was a very simple man, a man with very straightforward thoughts. Value investing, one could say, was in his blood. And he was always fascinated with numbers, balance sheets, trying to understand businesses, trying to understand human traits of greed and fear. And he always believed that wealth could be generated for the long term through investing in other businesses. So he would always want to partake in other businesses which would generate wealth, not only for the promoters themselves, but for investors at large. And he would love to partake into those stories, not for a short period, but for a very long runway. And like Mr. Buffett says, he would never sell a stock unless he found a particular reason to. So his thought process was fairly simple. Let your money work for you. And he pioneered the idea of compounding into the Indian equity markets. Not many understood what compounding meant at that point, but it was due to his knowledge and his reading and his wisdom that a lot of investment experts today, privy to this kind of a paradigm into investing, which has helped not only themselves, but millions of investors at large.
So Rajiv is popularly understood that your uncle's first big break was when Indira Gandhi made it compulsory for a lot of multinationals to list in India, and he very astutely got those shares. Is that correct? And if so, can you give us some details on that?
So his thought process was fairly simple, and his thought process was that if the multinationals were to do business in this country and they were to serve the people of this country, it's important for them to partake part of their wealth or part of their profits or part of their market cap with domestic investors. He was very, very clear that these were global giants. These were companies whose products were used by you and me on a day-to-day basis. The balance sheets were fairly simple to understand. There was no debt, and it was a very non-complex and a very non-complicated business structure that they followed. He loved free cash. He loved dividends. He loved the fact that they did not need capital to grow. And he loved the fact that he could remain invested in these companies for a large number of years without having to bother about really capital misallocation and mismanagement from the owners.
So to name a few, they would be Gillette, Procter& Gamble, Colgate, etc.
So a few of our large holdings that we held over the years would be Hindustan Lever, Nestle. In the very early days, companies like Bosch,
Right.
Companies like Procter& Gamble, Gillette, Castrol, to name a few.
So if one had to summarize his investing style, as you said, he liked companies that were big cash generators, so not debt-laden companies, ones that had a high ROCE. Any other factors that he looked at that were his set of criteria while picking stocks?
I think the criteria that he chose to identify the companies that he invested in were pretty simple. One, they should be dividend paying. Two, the ROE should be more than 20 to 25%. Three, the dividend consistency should be there and the dividend should keep increasing. And four is that there should be no need for fresh capital to grow year on year, in addition to the management doing the right things.
And that, of course, served him well at the time. But any misses later on in his life, so for example, when Reliance did an IPO or Infosys did an IPO, he didn't subscribe to those.
I think he was fairly clear on where he wanted to invest his money. He basically, at that point, Reliance was in its expansion phase. The company kept needing to raise capital to grow. He was not a proponent of a company that kept needing capital, because he would call that the cost of staying in business tomorrow. And he would prefer companies where businesses were simple to understand, like a Hindustan Lever product is used in your and my household every single day, be it war, be it peace, be it recession, be it inflation, be it anything. So his basic criteria was that keep it simple. The product should be utilized every day. Cash flow should be of pristine importance, and most importantly, they should not need money to keep growing. And the latter two that you named fell in that category, and hence he chose to ignore them.
In hindsight, though, would you say those were two of his biggest misses? I'm told Dhirubhai himself offered shares in the Reliance IPO.
You know, in investing, I think a humble investor always admits his mistakes, always admits his shortcomings. If I could say, looking in hindsight, definitely I think, the investment theory could have been tweaked, keeping in mind the fact that the runway to growth in these companies was very large over the years. But at that time, probably there was a lack of clarity in understanding the business of each of those companies very clearly vis-a-vis the multinationals that we were invested in, and hence the opportunity was missed. Looking back, I would say that yes, it is a regret, and we live to learn, and we learn from our mistakes and try and correct them so that we don't repeat them in future.
Absolutely. Now, turning to his personal life, he was very famously frugal. He didn't upgrade to a massive house in South Bombay. He didn't go around in fancy cars. Can you give us a typical day in his life?
So his thought process was fairly simple, and may not sound very apt in today's time and age, but he felt that every rupee that he had should work for him in helping him compound his wealth. A lot of people would disagree with his theory of putting a house under a consumption asset. A lot of people would, want to live life with having luxuries of a car and of, many other niceties that we enjoy. But for him, his one set focus was his health, his fitness, and investing, on which he dedicated, I would say, more than 100% and committed totally all his resources towards spending his time trying to master those in his own way, which I feel is commendable, because not many people today with his kind of wealth would have the ability to forego the luxuries of life that are even basic in today's world.
Right. So how would his day generally begin? Is it that he would start off with the stock exchange, and then how would it progress?
Well, Neil, he was a voracious reader. So at any given point, there would be 5, 7, 10 books on his reading shelf, and there would be a list of many more that that would be added, that would be given to him by well-wishers, friends, and so he would basically start his day reading. He would then visit the stock exchange. He was one of the only non-members to be allowed to visit the stock exchange ring without having any trading rights. He would spend his time in the ring meeting with friends. He would then dedicate the rest of the day towards his physical fitness. A lot of us would have seen him jogging at Marine Drive in the peak of the afternoon. And then he would go to his friends at a club opposite, spend his time there, and then come home and once again get back to his books and his reading. So It was a pretty monotonous life, but I think that was something he thrived on, and that was something he loved to do. All of us ensured that we give him that space and time for him to be doing what he loved to do.
And he very famously took buses everywhere, right?
Well,
Well into his old age.
he was a proponent of frugal living, and for him, frugal living meant getting from point A to point B at the least possible cost, and that involved using public transport. Even though there were resources available to him within the family, he chose to lead life the frugal way, and we appreciate his thoughts and his process, because he stuck by what he said and wasn't a proponent of doing something different from what he preached.
Now, Rajiv, towards the end of his life, so I think after the Great Recession, when he saw central banks around the world launching stimulus after stimulus, he exited a large part of his investments, right? Could you elaborate on that?
So the fear always was that money printing would lead to very high inflation, that would lead to very high rates, and whenever rates would go astronomically high, which he feared always that they would, the stock prices would ultimately not be able to keep pace, because in a high inflationary and a high interest rate environment, you always have earnings slow down. And he was very worried about, in his later part of his life, very worried about protecting his wealth rather than making many times more than what he already had. Hence he took a call, and a conscious call, to deleverage a lot of his holdings into cash, get a cash flow that he knew he would be guaranteed to get, and not take a risk in an environment where printing was rampant, for which none of us had answers at that point as to what would be the effect of rampant printing that the Western countries did. However, today's story, if we live back to tell the tale, is very different, and stock prices have gone many times X from there. But had it been the other way, he would have probably had the last laugh.
So when you took over from him in 2015, you would have had to deal with the question of deploying a large amount of cash?
Yes, it was. I was always lucky to have been mentored under him, and to have learned a lot of what he said in very simple words. And the fact that he kept emphasizing this day in and day out got it stuck into my head, that the process to be followed is pretty much this. When I took over the portfolio, the markets were, we were just about seeing the printing by the central bankers. And, we decided to slightly take a different view of how the markets would behave and how the stocks would do. And hence, we took a slightly more aggressive approach towards equity, reduced our debt component drastically, and moved into stocks which over the years, by the grace of God, have stood us in good stead.
When you say debt component, was it bank FDs or bonds, or how did he structure it?
In those days, predominantly, bank FD rates were 13, 14, 15%, and bond rates were in a similar range. So for easy liquidity and for cash flow, which he was a very big proponent of, he had most of the money kept into FDs, giving us quarterly interest, which would be reinvested or kept aside for contingencies.
So one of the big changes that you made is you did away with his philosophy of not investing in leveraged businesses, most famously banks. So could you take us through that thought process?
Well, the day I took over the portfolio, or the years I was under him, getting his mentorship on how to structure the portfolio, the thought was very clear, and the thought was that the ability to identify a consistent compounder. Now, this was ingrained to me right through growing up, but the definition of consistent compounders kept changing, and banks had a very bright future ahead. Most private banks were just about establishing themselves towards a large growth runway. And the famous thought process here was that if the country is to grow, banking is to grow with it. A lot of business was with the PSUs, and that shifted towards the private banks. And those private banks kept giving us, picture perfect growth for quarter over quarter for years on end. So I decided to digress a little bit from the absolute traditional safety theory, take a little bit of risk and get into sectors that were not in the portfolio historically, vis-a-vis banking and a little bit of a platform company base that we built up.
Apart from that, any other significant change that you made to his style?
Well, Neil, I've come into very big shoes, so it was really not apt for me to make a lot of changes in the theory that he propounded. The change that we made in our portfolio style was very simple. We basically divided the portfolio into two parts. One is an inconsistent compounder available at a good valuation, and a consistent compounder available at an expensive valuation. So we did not really disturb the consistent compounder at an expensive valuation, but we also did use the cash that we had to buy an inconsistent compounder available at a good valuation, and that has helped us balance out the return in the portfolio to a large extent.
So is it a more shorter term view now, or more, because some of these companies might have their earnings etc move in shorter spans of time than the consistent compounders?
Most definitely. I think the inconsistent compounders do have periods or bouts of outperformance and underperformance. Our ability as managing the family office is to be able to catch each of these and try and maximize the wealth that we can without having to deviate too much from the philosophy of the quality, the management, the business, and the moat around the business.
How concentrated is the portfolio that you run?
So, well, we run a portfolio with 20 names. We do have a concentrated portfolio to the expensive, consistent compounders because those are historically been bought and we have not disturbed them. Luckily for us, yes, luckily for us, those have also done decently well. But I must add here that the new inconsistent compounders that we bought and we got in and got out of and still hold some have given the kicker to the portfolio to generate a slightly better alpha than what we historically did over the past decade or so.
So in terms of turnover, what percentage of the portfolio do you generally churn in a single year?
I would say it would be not more than 15% because a lot of our core holdings still are untouched and a lot of them have been bought in 2 digits in the 90s and today are in 5 digits. So we don't really see a need to churn the portfolio unless there is a specific need or a specific event that we need to act upon. And like I said earlier in the show, the power of compounding gets disturbed with churn, and that's what we want to absolutely avoid. So we do hold on to stocks for long periods of time and try not to disturb that unless, like I said, a better opportunity comes in or there is a compelling reason for us to do so.
So what kind of return would you have got, let's say, over the past 10 years?
Well, the past 10 years have been good for anybody, so I would not have done anything great to have generated high double-digit returns, high teens for the portfolio. But having said that, I must say that we don't aim to have multi-bagger returns in 1 year and then zero returns for a very large amount of time. We prefer to let the portfolio have a steady upward graph, to let the compounding take its course at a reasonable pace, which gives it stability and which gives it longevity. And we don't get too excited in good times and we don't get too depressed in bad times. We're normally agnostic to very big market moves. Of course, we love drawdowns because it gives us the ability to invest our cash. And our process is pretty much simple.
And this kind of high teen return, you would say, is roughly what your uncle also had since he began investing?
Well, I would say that they're strictly not comparable. And I'll just take a minute or two to delve into that. When he was investing, it was in an era of where licenses were required. It was an era of very low capital that was available in the markets. Post 2008, post 2012, post 2015, we've seen that central bankers have injected dollops and dollops of money into the financial system. And I love to correlate this term with the price to earnings, because too much money chasing too few stocks inflates the PE of stocks in general. So for me to be able to correlate a 10-year return with his past return, I guess would be apples and oranges, because we were in different stages of capital market regulations and we were in different stages of central banker policies.
This year has seen a massive mid and small cap rally. How has it affected your portfolio?
Like I said, our aim is to identify companies that are available at a decent valuation and where we see some kind of a business moat, where we have some comfort with the management, where we have no debt, and where we have some kind of dividend yield that comes in. A lot of these small and mid cap companies do not qualify into that, and there are a few that we have taken advantage of and we have bought into, and we are happy that we bought into those. But by and large,
Portfolio would be?
well, I would say that not more than 5%. But by and large, I would say we've given it a miss. And if you really ask me, is it a mistake? I would say definitely not, because we have stuck by our investment philosophy and we have stuck by our investment theory. And these companies, however good and however fast they may grow, and kudos to all the people who have bought them and made money with them, but it just did not fit into our style, and hence we gave it a pass.
Do you invest in startups and IPOs?
There was a time when we would invest regularly in IPOs in the 90s. It was a very unregulated market. All you had to do was have capital in the bank, and within 15 to 30 days, your return would be 30-40% on listing. We did take advantage of that mispricing that the market gave us for a fair number of years. Ever since, the markets have become a lot more transparent. The process has become a lot more investor friendly, and most importantly, the money chasing these entities now has become so much that the pricing is absurd for any value investor to really allocate large sums of money. And even if you do, the hope and the guarantee of getting allotment to what is meaningful to the portfolio is very, very, very meager, and hence we've given it a pass.
And startups?
Well, startups are something that we have never invested in. We don't believe in, because the basic tenet of investing in our mind is easy liquidity and the ability to understand what the promoter is doing, the ability to have regular cash flow of what these companies are doing. A lot of these startups were into businesses which sucked out cash for a very large period of time, and they were valued on a very different matrix, which we did not understand. And I will be honest enough to admit that we were happy to let it pass, although we would have liked, in hindsight, to participate in a few.
And no mutual funds or pool vehicles that you use?
Well, the mutual funds are used primarily to park our funds for the debt. Equity mutual funds, to our mind, are a fantastic vehicle for people who are just about starting and for people who have no knowledge and no discipline of how to invest. But as we normally say, that a mutual fund captures the mutuality of the market. And if you really want to do something different, you have to think a little out of the box. And that's what we endeavor to do.
Your uncle, of course, was a great inspiration for the late Parag Parikh. Can you elaborate a bit on that? How much did they interact? Any memories that you have of course, Mr. Parag Parikh as well?
Well, so to begin with, along with my uncle, Mr. Chandrakant Sampath, my number 2 mentor was Mr. Parag Parikh. He's the one who who formulated my thought process into the inconsistent compounders and in going into where the very four strict policies that were followed by Chandrakant Bhai could be deviated upon. But having said that, he had a lot of respect for Chandrakant. Thanks for having me on the show.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.